Assalamu alaikum. As we have covered our first three chapters of this presentation of financial accountings, now we are moving towards our fourth chapter of this financial accounting, which is adjusting entries. In this presentation, we are going to explore the importance of adjusting entries in maintaining accurate financial records. We will cover various types of adjusting entries that are being used in this chapter, and we will also cover depreciation, accruals, and materiality concepts. This all will provide us a comprehensive understanding of the process and its significance for financial reporting. So, first of all, we are going to discuss that why are the adjusting entries needed? There are some basic requirements of them to be fulfilled. And the first need is the accrual accounting, and the other one is the time period concept. In accrual accounting, revenue and expenses are being recognized when they are earned or incurred, regardless of when cash is received or paid. For example, different employees are working for the different organizations. They work a whole month but do not get the salary, as they get the salary at the end of the month. So, first they provide the services, and after that, they are paid by the cash. So, for matching these, both adjusting entries are needed at the end of the periods. As the other need is time period concept. We know that the financial reports are being prepared for specific periods like monthly, quarterly, or annually. These uh, financial reports are being prepared. So, for the requiring adjustments to ensure accuracy within the chosen time frame that in which these financial reports are being prepared. So these are matched with the periods that in which expenses are occurred and in which the revenue is being earned. For all these reasons, the adjusting entries are providing a lot of importance. So before going to discuss the types of these adjusting entries, we will discuss the depreciation, that what is it and why is it so important. As a lot of businesses purchase a lot of assets for conducting the activities of their businesses, like buildings, tools, and equipments. These kind of assets, buildings, and tools and equipments face wear and tear, and they depreciate with the time. So, for matching the expenses as the assets are being consumed, these are matched with the periods that in which the revenues are being earned for that business. There are different methods of depreciation, and the first one is straight line method. In straight line method, after the cost minus salvage value, the remaining value is equally distributed to the estimated life of the assets. For example, if the value of an asset after cost minus the salvage value is 20,000, and we estimate that the life of the asset is 4 years, then the 5,000 for each years are being depreciated from the account of that asset. And the other one is accelerated depreciation. In accelerated depreciation, the years which are earlier, those are being charged much, and after that, the remaining years are charged less depreciations of these assets. So, after the depreciation, we are going to discuss the types of adjusting entries. The first one is assets to expenses. So for converting assets to expenses, as there are depreciation expense, supplies expense, and insurance expense. The depreciation expense reduces the value of a fixed asset, such as equipment, to reflect its usage and wear over time. And just like these, the supplies expense as these are being consumed during the different periods in which the companies earn the revenues. And same is the case with the insurance expenses. So for converting the assets to expenses, first these transactions are being recorded. As we obtain some assets like equipments or buildings, the accounts are being these assets accounts are being debited and the cash which we pay is being credited. So for over the time as these assets are being consumed, the those expenses are being debited from those accounts, and that and the which revenues which are being earned by those expenses are being credited, like these accounts which these assets which are being consumed are credited then. And now we move to the next adjusting type, which is the liabilities to revenue. As we have discussed that different employees and laborers work before they are being paid. So for the adjusting of these kind of entries, uh, adjusting this kind of entries is in this case like when the cash is paid to them, then the cash is being debited, and those liabilities which are created by providing their services are then credited from these accounts. And the next type is the accruing unpaid expenses. So in this case, the employees earn their wages by providing the services, but they are not paid at the moment. And same is the case with the utilities, that different utilities are being consumed but not yet paid. And the same is the case for the rent, as the accounts for the cost of rented premises that have been used but not paid. So for adjusting these kind of entries, those expense accounts are being debited, and the other related liabilities like paying the wages and utilities bills are being credited for adjusting these kind of entries. And then there is the last type of the adjusting entry, which is uncollected revenue. In the uncollected revenue, we provide the services on account receivables. We provide the services, and then in that period we are not paid. We will be paid later. So for adjusting these kind of entries, the account receivables are being debited and the unearned revenue is being credited. So now we move to the concept of materiality in adjusting entries. This concept is very necessary for preparing the financial statements, because a little mistakes or errors can affect these financial statements very much, as is the materiality in which a specific dollar amount or percentage that determines whether an adjustment is necessary or not. For example, 2% or 3% of large commodities can be exempted, and if that is not being recorded, that will be not an issue. But if the large amounts of those assets are not being recorded, then it will affect a lot to these accounts. So specific amounts and percentages are set, that to this much it is being exempted, and if these are not being recorded, it would not be an issue. But If we increase this specific amount or this specific amount, then it will be an issue if we don't record it. So this is the materiality principle. And now we move to the implementation of adjusting entries. The implementation of these adjusting entries can be made through the documentation, internal controls, and regular review. Preparing documents of these adjusting entries are necessary for having the records to be used in the future. And if some other external parties or the management is needed of these records, then there should be documents which provide the record of these assets or liabilities or whichever transaction they are going through. So for the implementation, there must be the internal controls which must prevent the errors and ensure the accuracy of these adjusting entries. And there must be regular reviews so that there must not be any misconduct or misconduct of these adjusting entries so that anyone can be affected because of these. And at the end, it is the importance of adjusting entries. These are crucial for informed decision making by stakeholders, including investors, creditors, and management, as these ensure the financial reports are accurately reflecting the company's financial performance and position, providing a true and fair view of the entity's financial health. And after using these, different persons which are interested in these financial statements can make the decisive decisions uh, of investments or crediting money to these companies. And the companies can also show that their financial health is at this position and they are liable of getting some loans or investments by their investors or creditors. So this is all in chapter 4.